Good morning, everyone, and welcome to this Kepler Trust Intelligence discount-led event. Shortly, we will be hearing from Yoojeong, manager of Aberdeen Asian Income Fund. The trust is currently trading on a discount of 13.4% as of yesterday's close. I think it's fair to say that the environment hasn't been favourable in recent years, with the outperformance of growth stocks and non-yielders, and the China underweight working against the trust. However, over the pandemic period, clearly there's been a lot of volatility, change of market leadership, perhaps a few different changes, and in a very different post-pandemic environment, perhaps there could be the catalyst for a change in sentiment. So shortly I'm going to hand over to Yoojeong, but first to remind you that the presentation itself will last around 30 minutes, and then there'll be the opportunity for you to ask your questions. Your microphones will all be muted, but if you look to the right of your screen, you should see a Q&A box. So please put the questions in there and I will put them to the manager at the end. I do apologise if we don't get to all of them. We've got a lot of people attending, but if we don't, we will pass those on to the manager afterwards. So with that, I will hand over to Yoojeong.
Thank you very much, Thomas. And thank you everyone for dialing in this morning to hear an update on the Aberdeen Asian Income Fund. My name's Yoojeong and I'm joining you today from Singapore to talk to you about this fund here. I'll just move on to this slide so you have some information in front of you. But the Aberdeen Asian Income Fund is a total return strategy that aims to invest in quality stocks in Asia that will deliver sustainable growth and dividends over the long term. We have about 60 holdings across countries, sectors and market capitalizations and offer 4% yield. And we've in fact raised the dividend per share paid to shareholders every year for over 10 years now. So I leave you some of this information to read later and just get into the bulk of the presentation. So the agenda today is going to cover why Asia for income, why Aberdeen, and you'll notice we have rebranded here, just on this side of my head, performance and fund positioning, as well as dividend outlook. So firstly, why Asia for income? If we look at where bond yields have gone over the past 25 years, we can see that the yield available for investors has trended downwards, and we are currently at around 1%. And this is a global index in US dollar terms, but the trend is very similar, even if we look at the UK alone. Meanwhile, equity dividend yields are looking much more attractive, still at 3% for Asia Pacific markets and 4% for this income fund. And if we look a little closer at Asian corporates, we can see that the dividend component of total returns in Asia has increased steadily over the past 2 decades, shown here in the purple section of this chart. And today we can find good yield stories in Asia that offer both dividend and capital growth potential. And these stories are spread over lots of different themes in Asia, where we believe we can continue to find these good returns for our investors. So there's a couple here on the slide for you. Cash flow generators. This is really one of the most important things for a dividend fund. We look for companies with strong balance sheets and cash flow generative business models that can support growing dividend payments in the future. We find this across sectors and countries, so the fund is pretty diversified, and we'll see that later on as well. Over the past year, this fund has enjoyed being invested in some of the large tech enablers and digital future stocks. So these include the global chip-making giant Samsung Electronics and TSMC, but also small cap stocks such as Momo.com in Taiwan, who like to refer to themselves as the Amazon of Taiwan, and we'll spend a little more time talking about them later. The rising middle class aspiration theme, that's still going strong, and we've invested to capture that growing discretionary spend, be it via retail, shopping mall property owners, financial services providers, that can all leverage off that growing consumer and favourable demographic story in Asia. And finally, going green spans across many sectors too. We own companies like China Resources Gas, which is playing an important role as China transitions towards their green energy targets. And we also own Power Grid of India, which is investing to increase renewables as a portion of energy mix for themselves and for India. And we own a small Taiwanese company called KMC, which makes components for e-bikes, which has seen good growth during this lockdown period. So lots of different sectors that are being spanned by some of these themes that we see on this slide. So we'll move on to why Aberdeen. And here you can see just a quick summary of some of the key points I'd like to share with you. So here at Aberdeen, we follow a quality-driven investment process. We pick stocks that have solid cash generative business models that can help us achieve our aim to deliver these long-term total returns. This involves meeting companies in Asia and having the language skills necessary to keep on top of local news flow as well. So that's supported by a team of analysts and fund managers located across Asia. There's over 40 of us, including 3 dedicated ESG analysts. I myself have been with Aberdeen for 16 years now, and I am the desk Korean. Similarly, lots of my colleagues represent different cultures here in Singapore, and we cover the different languages and markets as a regional hub here. And the fund also has a good proven track record as well. So we're ahead of the benchmark Asia Index, and we've been paying a growing dividend per share to shareholders, as I mentioned, for over 10 years. Part of our process is embedding ESG factors into our stock selection process. So we have a long documented track record of focusing on governance in particular in Asia over the past 2 decades, as that was really the low-hanging fruit in many markets. But our discussions with corporates are increasingly covering environmental and social issues as well now. We approach this in line with our investment process, so it's bottom up, with stock analysts engaging with their coverage companies on key carbon, climate change and social issues that are highlighted via the various tools that we use in-house. Ultimately, the aim of our ESG work is to generate alpha for our investors. On this slide that you see now, we use an external ESG ratings provider, so that's from MSCI, just to give us a reference point, and it can highlight information asymmetry in the markets. And we're more than happy to try and help our holding companies raise their own ESG ratings with MSCI, because a lot of the time the companies here in Asia are doing the right things, but it's just not disclosed in a manner to be picked up by MSCI. And that's really where the opportunity lies. If we can raise the external ESG score for our holdings, then this has a positive impact on the fund as well, as our underlying ESG scores will improve too. And just to summarize here, you can see that the fund's ESG score, as well as the individual component E, S, and G scores at the bottom, score better on MSCI relative to the benchmark. So I'll move on to performance and fund positioning. Gets a little bit small on this slide, I'm afraid, but I'll just quickly run through performance. And here you can see the fund's longer term performance figures as well. The Asian Income Fund is benchmarked against the MSCI Asia Pacific ex-Japan Index. And we also provide performance data for the MSCI Asia Pacific ex-Japan High Dividend Yield, or HDY Index as well, just for comparison basis, because this is a collection of the most high yielding companies in Asia. So it's probably something that's quite relevant for an income fund such as ourselves. If you look to the end of August, which is what this data shows, then the income fund is outperforming both these indices across most time periods. And you can see that on the top table. And we have provided investors with a 26% increase in NAV over the past year, whilst maintaining that 4% yield. More recently, over the summer in particular, Asian markets have corrected quite significantly, and that's really been driven by China, where several unexpected policy changes aimed in particular at the internet and online companies have shocked the market. And as you'll know, this fund doesn't own any of these Chinese internet stocks because they do not and have no intention of paying a dividend yield. So we've avoided the brunt of the e-commerce related market sell-off. And in addition, as money rotated out of China, a lot of it looked for safe havens elsewhere in Asia. And this coincided with the Singapore regulator, for example, removing dividend caps from the banks. And the fund has benefited from owning all three Singapore banks into this trade. So that's been good for us. And Taiwan has also been a strong contributor. And that's not limited just to the chip makers, as some of our best performers have come from other sectors in Taiwan, such as specialized retail. And we'll look at some of those examples later as well. And just in the middle of the fund, you can see the gearing profile. These figures are till the end of 2020, but we actually increased our gearing drawdown earlier in the year. So net gearing at end July was close to 9%, which is still well within our limits, but reflects our outlook of the markets in terms of growth and the funding costs that are available to us. And we're allowed to go up to 25%, but historically we've never been above 15%. And that's really just to be conscious of the leverage that we find in the corporates themselves. So we're aware that we're adding debt onto a portfolio where several of the income paying stocks in particular, those that are asset heavy, have leveraged their balance sheets as well. So that's something to bear in mind. And one of the reasons we usually keep it around 10%. If I go into positioning here by country and by sector, both charts, the fund is shown in blue, while the benchmark is shown in purple. So our largest difference versus the benchmark is our lower weight to China, and that's pretty significant, as well as our higher weight to Singapore. And our largest country exposures remain Taiwan, Australia, and Singapore. And these three markets are the biggest dividend paying countries in Asia. Sector-wise, on the right-hand side, we've of course benefited from the cash-rich and cash-generative chip makers of Asia. And I will go on to this in the next slide a little bit more. But we've also got quite good diversified exposure across other sectors as well. Notably, we have no exposure to healthcare, but this sector is not a dividend-rich sector in Asia as it is in Europe or UK, where the big global pharma companies pay good dividends with cash flows from their drug library. But in Asia, the sector is much more experimental and capex intensive. So that's something we haven't found a very good total return stock in that sector for this fund. I'll talk a little bit about the technology stocks that we own, because that is a big weight within the fund. And really, this is just to show you that we have quite a broad array of companies within that technology space. So all three charts are technology stocks that we own. The blue lines is share price performance, the purple line is benchmark performance, and that turquoise line is dividend yield. So the first one is Samsung Electronics. That's one of the largest holdings in the fund. We initiated this in 2016, the catalyst being the announcement of their revamped shareholder returns policy, which would look to share some of their wealth with their shareholders. So to give you some context, Samsung today is a $420 billion market cap company, and that's about the same as the top 3 companies in the FTSE 100 combined in terms of size of market capitalization. And they sit on a third of their market cap in cash on the balance sheet. So in 2016, they took the step to formally announce a dividend policy, and that was received very well. And you can see that the shares have done very well since then. The shareholder returns policy has come at a time that has fortunately coincided with a very good memory cycle as well. So we've benefited from an increase in share price. We've benefited from an increase in yield, and they've been doing buybacks and special cash returns as well, which don't get reflected in that turquoise line. So overall, on a total returns basis, Samsung's been pretty profitable for us. Infosys in the middle, that's a digital Indian IT services provider. Essentially, they're providing outsourced IT services digitally to companies globally, earning revenues in US dollars, but operating with an Indian rupee cost base. So again, a cash-rich balance sheet coupled with a strong growth outlook. We initiated this in 2017, and you can see that we've enjoyed good capital growth and enjoyed a good dividend yield as well. Infosys also pays special dividends, so that again isn't captured in the turquoise yield. So this has been a good total return story for us. And finally, venture. And we've owned this since the fund inception. so well over a decade. And you can see if you look to the left of the venture chart, it was clearly a dividend stock. It was high yielding. This is a Singapore widgets manufacturer, but the widgets they make are core components in some pretty high tech machinery, such as genome sequencing machines that sell for over $1 million per unit. They also do components for 5G infrastructure and COVID diagnostic systems. So revenues are well diversified again, but the key is the critical nature of the components they manufacture, and that's enabled them to generate industry-leading profit margins. So this means good cash generation, which translates to good dividend-paying pockets for investors. So we've traded venture around valuations, but it's really been a core holding within the fund for over a decade now. And these are our top 10 stocks. We touched on several of them already. But one thing I would note here is that the dividend yield on the right-hand side, some of them look very low. So things like Momo.com, for example. But just keep that in mind because I'm going to come back to Momo.com. But usually when we initiate stocks, then they do have a 3-4% dividend yield. And if you look at the names with low yields on this chart, then it's really been driven by an increase in share price rather than companies not keeping up with their dividends during 2020. So, yeah, Momo is coming up, I think, in 2 or 3 slides. So OCBC first. I just wanted to put in an example of something a bit steady as well. OCBC is one of the big 3 Singapore banks. And as mentioned before, one of the key risks for this portfolio is the underweight to China. But even in the years when Asian markets have been dominated by the Chinese internet stocks, some of our most defensive names, such as OCBC, were still able to grow ahead of the benchmark, whilst paying an attractive dividend yield as well. In 2020, we saw the Singaporean regulators cap dividends for the Singapore banks, but this has just been lifted over the summer this year. And so we see OCBC once again as a good total return stock within the portfolio. And the next one, finally, we come to Momo.com. This chart only goes back 3 years, but Momo's actually been in the portfolio for a decade now. It hasn't done too much over that time, but what we liked it for is that it paid a 4% dividend yield. And it's an e-commerce platform, a bit like the Amazon of Taiwan that I said earlier, but unlike its Chinese peers, Momo.com sits on a net cash balance sheet, which supported that 4% yield. And then over the last 3 years, as you see on this slide, the share price of Momo.com has increased by over 10 times. It's been a 10 bagger. I don't know how many stocks can say they've done that over the past 3 years, but that increase in share price has basically resulted in the yield of Momo.com coming down below 1%. But over the 3 years, they've actually been increasing their absolute dividend per share on a dollar basis. And the yield has only dropped because it's not been able to keep up with what we've seen their share price deliver. So that has been, again, a good holding within the fund. I think if I just bring it all together in terms of our discussion and the stock examples that we've seen, then slide 18 shows the outcome of our process, and stock picking is and the outcome of our process and stock picking, and that's a portfolio of stocks that have higher profitability versus the benchmark, higher return on equities, and higher dividend yield versus the benchmark as well. And that's really what we're aiming for and trying to sell to our investors as well. And one other thing I would highlight is that the improved performance seen over the past few years, that's not been a result of us churning the portfolio and ranking up big transaction fees. You can see here on this slide that although we were slightly more active in 2020, as market volatility gave us a chance to buy into stocks at lower prices, which we thought were expensive before, portfolio turnover still remained below 20%, so still quite modest overall. So lastly, I'll come to dividend outlook. And here, just to give you a sense of earnings growth outlook in Asia as well. So The left-hand chart here looks at earnings growth forecasts and the value markets, the dividend-paying markets. These are the ones that are expected to show the strongest earnings recovery. And of course, higher earnings means higher potential to pay dividends. And this chart broadly maps onto our portfolio positioning that we looked at earlier as well. On the right-hand side, you can see that balance sheets in Asia remain very prudent, particularly relative to some of the global regional counterparts. So again, this provides corporates with choices that perhaps are not available to their more leveraged global peers. So corporates can choose to increase dividends, buy back shares, invest in growth, or go after inorganic opportunities. So all of these have the potential to increase value to shareholders, and it's an option available to Asian corporates because they've been able to manage their balance sheets better and keep their balance sheets stronger as well. And then this slide just shows quarterly dividends paid in Asia Pacific in US dollar terms. Didn't realize quite how colorful it had become with our rebranding. But again, this provides just an overview of how dividend payments have been in Asia. If you look at the second quarter of 2020, that saw a big decline in absolute dividends year on year relative to the second quarter of 2019. But since then, you can see that dividends paid in Asia have actually already returned almost to pre-COVID levels. So there's plenty of scope still to invest in dividend payers in the region. And we still find good dividend paying stocks for the fund as well. And of course, the dividend outlook for the trust itself, everything we've discussed so far supports our ability to keep paying dividends to shareholders. You can see we've continued to increase our dividend each year on a per share basis, and that's been for over 10 years now. We dipped into our revenue reserves last year to maintain this dividend growth, to keep this dividend growth trend for 2020. But you can see even this year, we've got close to 50% cover left in reserves for this year's dividend as well. And I think if we look at where dividends are tracking for the fund so far this year, then we're certainly looking better than we were at this point in 2020. And what we're trying to achieve is to get back to pre-COVID levels ourselves. And that's something we'll have better clarity on as we get the final dividend announcements from our corporates heading into the end of the year. But certainly we do have good coverage. The coverage we have today will be more than enough given where we are on a year-to-date basis to ensure we can keep the dividend growth trajectory going for the fund as well. So really, to summarize what we wanted to cover today, then why Asia for income? I think dividends are increasingly important as a contributor to total returns in Asia and offers a good source of yield to investors that's difficult to find elsewhere. Why Aberdeen? That team of 40 analysts and fund managers based in Asia with the established track record in the income space, applying a quality-focused investment process with embedded ESG engagement as well. And I think performance-wise, the quality portfolio has outperformed the benchmark over the short term, certainly, and we are gaining performance over the long term as well. And that's all the while supporting a dividend yield of 4% and that growth in dividend per share over the past decade. And I think the outlook as well is supported by our underlying investments and our revenue reserves, as we discussed in the last slide. I'm aware I didn't cover a lot of topics on China and inflation, but I've actually seen them pop up in the Q&A. So perhaps I ask Thomas to come back in and then I can take those as questions instead.
Brilliant. Thanks very much, Yoojeong, for your presentation. You're quite right. Both of those topics have come up in the questions, and there are a few more, but we please do keep questions coming if you're in the audience. We'll try and get through all of them. I think one of the points that came up, so you did did discuss the revenue reserves and the dividend cover ratio at the end there. But I suppose one of the key differentiating factors for this trust is that you focus exclusively on natural income. So some of your peers will pay a dividend from capital. Could you just explain what that means in terms of how you manage the portfolio slightly differently?
Yep. So the dividends we pay come from the dividends that we collect from the companies that we invest in. One thing we do, but we don't do very significantly, is write covered options. So that's something we also do for this fund as well. And the only reason we don't do more of it is actually because the options market is quite difficult on a single stock basis in some of the Asian markets. So we don't want to add speculative risk by writing options over liquid stocks that we don't own. Everything that we write is covered in the sense that we own that stock in the portfolio. And there's a couple of restrictions in terms of foreign exchange and liquidity profile that stops us writing options freely across the whole portfolio, as well as the cash that we have to ring fence for every covered put that we write. But we do about 3 to 5 options a year, and that adds about 30 to 50 basis points to our income as well. So it's not big, but it's still there in terms of supporting our revenues. But apart from that, everything else is the dividends that we collect from our underlying holdings, and we don't manage it any other way.
Thank you. Yeah, because there was one question around the discount of the fund relative to the peers, which is probably a little bit unfair to ask you to answer, given that it's sort of speculating about your competitors. But I would suggest that maybe that's one of the reasons that for the funds that have been able to pay from capital have been invested in the growthier areas over the last couple of years, whereas that was very good in 2019, 2020. As you've seen year to date, your approach has it's by far the best performing Asian income fund in 2021. As I think that there's been a real change in how the market views quality dividend payers. So that was by way of my explanation for why the discount might have been wider.
It is pretty wide though, so I agree on that. And I think performance has picked up, and I think longer term performance is looking better as well.
Yeah, and one of the factors behind that, I suppose, is that your lower weighting to China, and we had a question around what's going on there. So specifically, I suppose the debt issues which are focused on the real estate sector in Evergrande, but then there are also regulatory issues which have caused some problems in the country. Does this have an impact on wider Asian markets and on your fund, despite the fact that you don't invest heavily in China?
Yeah, so if we look at China in the benchmark, it's close to 35%, whereas in this fund it's 10%. So we've benefited from being underweight China, certainly over the past couple of months, but it's not to say that the 10% that we do own has, remained unscathed, because we've actually also felt that negative sentiment on the companies that we own as well. And if you remember what I was saying about how we want to choose the high quality companies, even within China, that have that strong link to domestic consumption, that's what we've done. And yet we've still seen the share prices correct alongside some of the very highly leveraged property companies. And I can see that some questions have mentioned companies by name like Evergrande as well. So we obviously avoid companies that have very stressed balance sheets. And the reason we do it is precisely for moments when there is a liquidity squeeze, or when there is cyclical market events that squeeze the business model. We don't want to be in a position that we are holding on to companies that have unnecessarily taken that financial risk onto their own balance sheet. So we avoid companies like Evergrande and their peers as well. But we do have property in China. We've got companies like China Resources Land, China Vanke. We also own a Hong Kong listed company called Hang Lung Property that owns shopping malls in China. But the reason we've chosen these companies relative to the likes of Evergrande is because they don't take that amount of risk on their balance sheet. These companies either have very modestly geared balance sheets, or they have investment properties that are generating a income stream which funds their development activities as well. So that's been something we've taken quite a bit of care on in terms of when we go into stocks, not just in China, everywhere across Asia, in fact. And we also like the stocks that are better aligned with the strategic aims of the Chinese authorities as well. So if you think about our preference for that domestic consumer, then that's certainly aligned with Chinese authorities and this common prosperity theme as well. We also want that balance sheet, and we also want transparency. So the other big missing thing for Evergrande, I reckon, is the transparency aspect. There's just so much added complexity due to the opaque links between some of these real estate companies and the wider economy as well. It's difficult to gauge exactly how far-reaching the real estate sector problems could be in that sense. So we hear from a lot of sort of sector specialists and experts on the ground that Evergrande is a very small portion of home builder lending in China, and that home lending in China, again, is also not a significant amount of GDP either. But actually, it's not that clear if you put in the whole sort of upstream and downstream companies that are associated with it. So I think it's worth being aware of that risk as well. And that's really a key reason for us to steer clear of over-leveraged companies precisely for that reason. And I think just on the regulatory thing, we've been here in Asia investing in China for over 20 years now. And I think this sort of heavy-handed regulatory decision from China that's come this year, it's surprised a lot of investors who are recent investors into China. So people who were attracted to invest into China due to things like, the online internet companies that have done so well over the past 3 to 5 years. So this has come as a shock to them because they've only known growth and favorable regulations. But if you go back and look, 10, 20 years, then this sort of big brother hand rule of China, that's always been there. And it's one of the key reasons we avoid the state-owned banks, for example, some of the state-owned utilities as well. Where we don't feel we have good transparency and there isn't good disclosure, then we don't feel we need to put capital at risk in these companies, because we can find good companies elsewhere in Asia that give us good exposure. And that was one of the reasons I showed you the chart on OCBC. It's often considered to be, boring and defensive Singapore bank. But actually, if you look at it relative to the index over time, then it's done pretty well, even though it hasn't had the same excitement as the internet stocks.
And staying on the theme of China, so there's a question around, I guess, the impact of climate change commitments, net zero commitments, and what that means for China's business model. And I suppose if we think about the issues with the power in the power market at the moment in China, should we attribute this to these policies, or are there more other different reasons for this?
Yeah, I think this one's very difficult as well. So again, I think if we just try and think about what the government is going to focus on, then as well as common prosperity, the other one I should have said should have been their climate change targets. I think that's very important for China, not just for themselves, but also for their positioning in the global political wrestling ring, if I can call it that. So I think what they're committing to is obviously very good, and everyone's very supportive to see China meet these goals as well. And I think where we find companies that are leveraged into that trend, companies like China Resources Gas, then anything that helps China transition to a more clean, green energy economy, I think is very positive. But like some of the questions here are pointing out, I think it's very important to make sure that you do that stock picking aspect of where you invest in, even for themes like this, which seem to be just overriding the good themes, because there will be people who get caught out. It'll be similar to the real estate sector as well, where probably some developers just got ahead of themselves by front-running urbanization policies in terms of how much they stress their balance sheet. That's something I think we could see within this sort of green energy space as well. So it's really being aware of what your companies are doing, how they're managing their balance sheets, and just making sure that you pick your stocks from that bottom-up perspective.
And in terms of the regulatory reforms and the changes of policy, I suppose, that we've seen, has this caused you to sort of fundamentally reassess some things? Do you view these as long-term changes, or are these, stock-specific issues?
So I think it's a mixture of both. So probably, if we look at what they've come after, then it started with education. So I don't know if everyone's been following this, but really it's been trying to make things better for the consumer and trying to make China more equal for everyone in line with that common prosperity theme. So the first thing in the summer that the Chinese government went after was online education. And it was a shock to everyone who invests in online education companies. But if you think about what they're doing, then you can't fault a government for trying to make education accessible to everybody. And they're trying to make sure that private companies aren't benefiting while sacrificing the ability for the masses to have access to education. So what they're doing is not bad in that sense. So they're trying to create a better social equality platform. And if you look at the other things they've done, then again, it's just trying to make sure that they balance regulation in a sector that has seen high growth whilst not curbing innovation going forwards as well, because obviously that's very important to China's growth policy. And we all know that growth is China's #1 aim in order to keep that one-party regime and keep that rule over the country as well. So I think it's difficult to say that there aren't stock-specific risks in the market, but I think, again, it's just about knowing where you feel comfortable with in terms of quality of the companies that you're investing in, the sectors that they're exposed to, and whether they can be winners at the end of all of this. Because even the internet companies, I think they've been sold down very harshly. And if this wasn't an income fund, I think some of the internet companies are looking, will start looking quite attractive for investors to get back into at some stage. Obviously for us, it would be a mix of looking good value and delivering on a dividend as well. So that's what we're waiting for. But there is opportunity still. I don't think they'll stop growth for internet companies. I don't think they will handcuff innovation or development of the Chinese economy at all. So it's really about trying to make sure that you support the companies that are best aligned with what the government is after as well.
And has your view of corporate governance in China changed then, the way you approach it? And when you talk about finding stocks that are aligned with the government, is that something that you've, a strategy that you've developed over time? I suppose, relating it to income stocks, I think a lot of the higher yielders perhaps in China are more closely intertwined with government interests or large government shareholdings and so on. Do you find it hard to sort of hold the line against investing in these companies with their higher yields, given
Yes.
the risks?
But I draw a distinction between state-owned companies and companies that are aligned to government priorities. So for example, the highest yielders in China are the state-owned banks. And again, we don't own any of these, although you could argue that they are maybe the most aligned with the state. And that's really because we don't get the same transparency as we do for banks across the region. We don't get the same feel for management and their willingness to protect the minority shareholders as well. There's a little bit more national service risk with the state-owned banks in China. Whereas if you look at the Australian banks or Singaporean banks, then we don't have that kind of risk to these companies, and we still get good growth and we still get good dividends as well. And what we do like in China are companies that don't have to be state-owned. We're not ruling out state-owned companies as a whole, but it's just about knowing who the end beneficiary is and who makes the decisions. And I think what we like are companies that aren't necessarily so subject to national service risk, but are in the right sectors of the economy to serve the growth areas within the economy in China that the government is currently pushing. So, you know, all the green energy stuff that we spoke about before, then again, I think that's probably a good area for you to try and find a good quality company. And I think governance has improved over the years. And maybe if it hasn't improved, then the disclosure of what they're doing has certainly improved. Maybe all the Chinese companies were already doing the right things. We just didn't know about it outside. But I think their willingness to meet global sort of environmental standards, that's being much better communicated, and they're more open to feedback as well. We've had companies in China come to us and ask us for feedback in terms of what they can do to better align themselves with companies across the world that we look at. And that's been great. Like that would never have happened 5-10 years ago. But now they're actively seeking outside shareholder feedback from long-only institutions to try and make their own ESG policies more attractive to foreign investors. So I think moves like this is a real signal of how open parts of China have become, particularly on that governance front. I think this is very good development, and I hope more of it happens as well.
And moving on from China, I mean, it's been raised in the questions that you're also underweight India, which is a very different market. So perhaps you could explain why you don't find so many stocks in India, and perhaps I could tag on to that on a more positive note. So you do invest in Australasia, which is again a differentiating factor from some of your peers. Perhaps what does that add to the portfolio? What sort of companies do you find there that you don't find elsewhere?
Yep. So India, I think, is a great growth market. I think there's a great story there. But India has been so growth driven that a lot of the companies there don't feel they need to spend on dividends because there's so much home growth to spend on. And I think that's a little similar to China as well. So naturally, the first companies in India to start paying dividends will be the cash rich, sort of asset heavy companies like the telcos, the utilities. So we're really trying to find nascent sort of dividend winners within India. So we have 3 stocks in India today. And the first one was only initiated in 2016. So we've not had a long history in India in the income fund. And that's really just been a reflection of the Indian market not being a yield market. But as more companies start focusing on shareholder returns, then we've been growing our weighting in India as well. I think Aberdeen as a house, we're very much overweight India in our non-constrained portfolios. So in terms of idea generation, there's a lot of that. We cover most of the India market, and we've got very good India country funds as well. It's just that we don't find that total return side of India that's suitable for this income fund. And that's very similar to Korea as well, where we just own 2 stocks. And that's been a Samsung Electronics story related to dividends, as we spoke about earlier as well. If we look at Australia, then that's one of the highest yielding markets within the Asia Pac region. Australia, Taiwan, and Singapore, the big dividend paying markets. And to go with that, those 3 countries are our highest absolute weighted countries within the fund as well. Australia gives us exposure to the global mining stocks, so we trade around valuations there as well. Obviously, when things are going well for the mining stocks, then you get special dividends out of BHP and Rios, and earnings are growing and the cycle looks good. And then when things are not going so well, you try and manage that with the weight within the fund and wait for the cycle to come back in your favor. But these are good yield stocks, regardless of what part of the cycle they're in. And the dividend is often supplemented with special cash returns as well. There's a lot of property companies that we invest in that gives us exposure to shopping malls, petrol stations across Australia, all very good yielding, stable, defensive companies that have been good yielders, particularly over 2020 as well. And the banks in Australia have been good dividend payers for us too over the years.
Well, perhaps you can find a way to invest in UK petrol stations, boost the yield even more. Thanks very much, Yoojeong, for the presentation, for the questions, and thank you to all our attendees for your attention and for your good questions. Please do send through any final questions, and we'll put them through to the manager if we can. I do hope you'll stay with us for the rest of the day, but for now, say goodbye.
Thank you.